Good morning, ladies and gentlemen. As always, we start our review with the fixed income markets in the US. This is a chart of 5-year note yields and price. As we can see, we kept on telling you about that 118.03.5 level, and we closed the week right on top of it. The market tried the lower Bollinger Band, rejected on Friday, came back within the range. Basically yet another sideways week with attempts to push yields higher, which have not succeeded. The market closed in yield lower than it opened. We think this type of price action continues, and the yield curve probably continues to flatten. It is certainly not a market that is worth positioning for very big moves. Certainly the 2% area in the 5-year note is going to be very tough to break, and also anything around the 170 is going to be very well supported. So not a lot going on, which tells us that there will be no trends developing here in the short term, just continuing yield curve flattening. The 10-year shows very much the same pattern, but probably with more room to appreciate in price or down in yield. We still think this area around 213 at some stage gets tested, the gap filled, the level rejected, and only then will we be able to make the next move higher. Will the moves higher take place? Yes, we think so. We think the American economy now seems to be firing on all cylinders in the second quarter. We have the healthcare bill making its way. We probably will get more and more talk about the tax reform bills, and that should all conspire to push yields higher towards the end of the year when the Fed gets more aggressive in its hiking. But for the time being, we think it's very dangerous to be excessively short of fixed income, simply because we are not seeing any technical indicators that say that a trend can develop from these kind of levels. We need much more churning before we are ready to do so. The only markets which seem to be setting up for bigger moves towards the end of the year are the European fixed income markets. We've been saying for a long time that we see no possibility of higher rates worldwide before Europe starts finally getting into positive territory. This is a chart, a weekly chart of the 2-year note. It is finally turning a corner. It has been basically in a downtrend for best part of 2 years since we hit the negative levels, but the last 2 years have shown you that there is absolutely no reason to expect this yield curve to start shifting up. Things are slowly changing. We think we'll be several more weeks of moving sideways before we're ready to break, but we do expect an upward break. This is the 5-year note. You can see that how long it has been taking to change the trend upwards, basically since the middle of last year. So we've had 6 months of sideways to higher ranges, which are now giving you a technical possibility that the market will go higher, and much the same thing in the 10-year note in the Bund, which has shown you that the market is beginning to anticipate higher yields coming in the weeks and months ahead. The one problem for Europe to go now is that the Italian bond just does not signify it. The Italian bond closed at 217. It is now trading in the middle of this band. The Bollinger Bands are contracting. It's going to take quite a bit more time for that to happen. So what is happening? People are abandoning the safety of Germany and the low yield of Germany and trying to put some more risk on trades, i.e. by buying Italy and getting some yield. And Italy is trading at the same level as the US. Therefore, they are selling Germany, buying Italy, buying France, because the political uncertainty, they say, is going to be out of the way. Well, we think that might take 1 or 2 more weeks, and then the Italian bond will be at levels against the German bond, which are very attractive to go the other way. So that is what we're looking for, and that is what we're waiting for. We're waiting for Italy to give us a signal that the whole of the European yield curve can now move higher. The lethargic movements in fixed income are now actually making people put on risk on trades at very bad levels. This is the SPX. We had a dramatic acceleration in the last hour of trading on Friday, where 10 points, and we probably will get some follow through first thing on Monday and Tuesday up towards 24.10, 24.20. That is as high as we can see the market going for the time being. We are getting ready to short these markets simply because the kind of acceleration that we've been seeing is completely untenable. The real market which has been accelerating has been the European stocks. Huge relief rally, and this is a weekly chart. As you can see, we are way outside of the weekly Bollinger Bands. We think certainly we will have a retracement at some stage to within the Bollinger Bands, whether it comes at about next week or the week after. We think that these levels are completely unsustainable. We might have a move to 3670, 3690, but that we will have lots and lots of resistance at these levels and a counter move back down below 3500 before we are ready to go higher. So we think that people are getting lulled into a very false sense of security here in equities. We are getting ready to short them, and we think that this is not the time to put on risk on trades. These are people who have missed the move and who have decided that they have to have some on board. They will probably regret it, as people always do when they act in haste. This kind of formation, this kind of pattern of just get me on board at any price always ends up in tears, and this 3700 level, if seen, will be a great level to buy puts for a move back down to at least 3500 in the European stocks. And last week we had the same kind of euphoria in the euro. It finished above its Bollinger Bands, but the MAs are still pointing down. We think there's a very big risk that the euro in the next 2 or 3 weeks rolls over and falls back towards at least the 108 level. We definitely would not want to be long of euros at these levels. This kind of 110.50 area is going to be very, very tough to break, and only closes above 111 would impress us. We think the chances are that we could come back all the way back to 107 without much problem. That actually gives us a very good selling opportunity for FEU. I know many of you got long of FEU in our recommendation. The trade has worked perfectly, and now it's time towards this 35 area to take profit for the short term, looking to reload when the market gaps back down. Will FEU trade towards 35 in the next several months? Yes, it will, but this is just too strong a move. We are outside the Bollinger Bands. We are outside of all technical reasonable levels for this time. So we think it's far more likely, the odds are in your favor to take profits and reload back towards the 32 and a half area. Speaking of FEU, this is a chart of SPY FEU. We warned you when it broke this level that it was time to buy FEU over SPY, and the trade has worked wonderfully. It is now definitely overextended for this part of the move. We are bound to get some sort of retracement back towards the 741 level, probably test this 200 day moving average from underneath, and then move back down and into support on this trend line. This has been a very big move. It has an equal move to go, which is another 3 to 5% over the course of the summer, but we think it is silly to have it keep on having it on for the time being, because it could very quickly retrace back to these levels and then go again. Definitely time to take profit on this spread. Back to our favorite chart of XLF with the yield curve. As you can see, not a lot happened last week. We told you, watch the 24 level, watch the 24 level. Can the market close above 24? Well, no, it couldn't. We will be sellers of new highs in S&Ps as long as XLF cannot close above 24. It is such a clear technical level, and it is so clear fundamentally why S&P can only have a greater downside than upside here if XLF does not give it a helping hand. XLF is nearly 20% of the index. If this is a market which now breaks down through sheer weight of what it has done over the past several weeks, then S&Ps can have a really unpleasant time and test even the it could easily have a 5% retracement. So we're talking a move in S&Ps from the 2400s back down to the 2320, 2330 level that we saw a few weeks back. It can be a real cascade. All we need is for XLF to start giving up the ghost here, not being able to break 24, and the market reaction is going to be probably savage. We will definitely trade around the 22 area, which will take the S&P down quite violently and give us the reaction from the 2410, 24 level that we were looking for. Going back to SPX, this is a chart of ES weekly. As we can see, we would love to see it touch the 2425 to 2440 area, where we would definitely be buyers of puts. We think that that will be the high until at least August. We will have several weeks and months of downward price action afterwards, and certainly fill all the way back to 2330, 2300. We would be looking for a good 120 points down from this high which we reckon will be around the 24.25 to 24.40 level. Uh, that would be a gift, in our opinion. The market would then have exhausted its risk-on period, and we'll be looking for 5% correction going into the summer before we have a final leg up in the fifth wave of five. The Elliott wave has been working very well. This is not the fifth wave, this is the fifth wave of the third wave, and therefore we will be looking only for marginal new highs around the 24.25, 24.30 area. Anything above that, we will be aggressive buyers of puts for a substantial move down of at least 5%. The commodity charts that we've been telling you that we have to look at to confirm reflation are actually doing exactly the opposite. They are not confirming reflation, and that is why we just don't see how XLF can possibly help this index to go much higher. Oil has broken down, gold has broken down, silver has broken down. Everything is telling you that prices are going down. Therefore, I just don't see how the risk-on trade is going to be supported at levels above 2400 in SPX. The market is overextended and way over optimistic, with a huge amount of indicators telling you that exactly the opposite is happening in the economy. The Citibank Economic Surprises Index is negative. The commodities are falling out of bed. There is absolutely bonds are definitely not in an uptrend in yield. So all these indicators are telling you that the reflation trade is in great trouble, not least the dollar index. As we keep on telling you, the dollar index is far more likely to start gapping down and going down than breaking upwards. We don't think it's going to break now down, straight down, and keep on going down, simply because we think yields are not ready to start going down. But on the other hand, it is far more likely to only have marginal improvements before one day just gives up the ghost and breaks 96 and goes down towards 93. Therefore, we just don't see how the SPX is going to be able to maintain the risk-on profile that it has now, and that it's likely going to have next week. It is far more likely to be a case of buy the rumor, sell the fact with the French election as far as the European bourses are concerned, and we just don't think that SPX will be able to maintain these huge gains it's had without a lot more retracement and a lot more pain in the weeks ahead. In our relative charts, we have a very interesting situation in XLP, which is the consumer discretionary, over SPY. This is a very long-term chart going back to 08, and as you can see, when the market is in risk off, price goes up, and when the market is in risk on, price goes down. Well, we have this huge support which has been holding it since 2011. Basically, it's been in a range since 2011. You can just draw a parallel line, and you can see how basically it's been in a perfect range since then. If we are going to have risk on, we are going to have to, from these levels, we're going to have to break this trend line, and that will be, to us, just very unlikely at the moment. If we do see it, then we are absolutely wrong, and we are in a very, very strong risk-on period, and we will just get out of the way. But we think it's far more likely that we have a very quick retrace, which will give us the 100 points or so on the downside in SPY that we are looking for. Finally, one indicator that we'll be watching very closely and tweeting to you next week. This is SPY over TLT. If next week we have a brief rush up in SPY, chances are that we will test this downtrend line from below. If we can't keep up there, we think we will roll over and test this support into the summer. This is a long-term process. This is going to be several months of move down, but it will tell us that risk on is exhausted and will have created a negative divergence, because it wouldn't have made a new high on the move, and then we can definitely have a very nice move down back towards the 180 level, which would certainly coincide with at least a 100 point move down in SPX. But this is something that we'll be watching very closely next week to give us the timing for our risk off move. And finally, the biases for next week. We still think that bonds are in a range. These breakpoints, the market well closed right on top of them, and therefore it shows the indecision that the market has. We think it's far more likely that we are going to get a simple yield curve flattening move than a trend upwards in bond prices. Bunds and bobble, exactly the same thing. We think now it will be a question of people panicking into Italian bonds and selling bunds, but at some stage that trade will be reversed in spades. So we will not be sellers of bund and bobble here. We think it's bad risk reward. We would be looking for levels to do the opposite against Italian bonds. And that is because we just see absolutely no reflation from commodities. It is unlikely that in a scenario where you have much lower oil, much lower gold, much lower industrial metals and so on, you have a sustained big move in bond prices higher. The economy is doing all right, but it's not doing that fantastic. So we think it's far more likely, and the Fed will definitely tighten as well, which is something which tends to give you a flatter yield curve. So we think it's far more likely that bond prices actually test the 0.382 retracement at some stage, rather than just make a bolt for higher yields. And going back to equities, we are finally getting this acceleration that we got in both the US market and the European markets late on Friday. This is what you want to see at the end of a wave. We believe we are now in the at the end of the third wave, so we're in the fifth wave of the third wave, which now will give us the fourth wave retracement, which will be at least 5%, we believe, over the course of the summer, before we can make further attempts to the upside. European equities are very dangerous up here. They can have a 3, 4, 5% retracement at any moment. Therefore, we think it's unlikely that you should hold full positions at these levels. You should definitely take profits and then look to reload further down. DX, we think it's not going to do very much here, but eventually over the course of the summer it'll have worked off, it will have coiled enough to signify the next move, which we think will be lower. And this is now our primary focus into the summer. The short bubble, long stocks, as soon as the market retraces the portion that we think it will retrace, we are ready to pounce on what we think is going to be the third wave of this, when yields go substantially higher and equities also go substantially higher. And that we think is going to take place sometime towards the middle to end of the summer. So we let the first wave go, but now we are ready to pounce on the third wave in the next few months. Thank you very much indeed, and we'll be with you on Monday as always.